Hello everyone, welcome back. We are now in chapter 3, and in this chapter we'll be discussing about accounting process. Please note that this is an optional chapter, right? This chapter actually discusses about the what happens in the background while preparing the financial statements. So in your normal banking job in the area of credit appraisal, you will be given a completed balance sheet, right? A balance sheet that is totally prepared and complete in all respects. So you need not actually go into the process of preparing a balance sheet. You will never do that. That's not a job, right? And this process and this in this chapter is all about that particular stage where you prepare the balance sheet, how you prepare the balance sheet, how are the entries passed. So it's a very technical concept. How are the entries passed? What are the books of accounts maintained? What is a journal ledger? Trial balance. So this chapter can become quite technical at times, and you might find it very difficult to follow. So that's why I said it's an optional chapter. In spite of not opting for this chapter, you can still follow the rest of the book without any problem. But this chapter is included for two purposes, right? One is to provide a totality and continue to do a flow of discussion. Balance sheet analysis is actually the second part of a series of steps which you take in finance, right? The first step is actually preparation of balance sheet. How you prepare the balance sheet. So even though you do not require an in-depth knowledge of how it is done, this chapter provides a nice overview of what actually happens in the background, right? So that's the first purpose for which we are discussing this particular chapter. The other reason why we are discussing this chapter is sometimes in your job as a credit officer, you'll be requiring more information than what is present in the balance sheet. See, for example, when you see an item called debtors, if you see an item called debtors in your balance sheet, you usually in the form of in the head of assets, right? So in your balance sheet you can have a item called under assets. You can have a item called debtors. Usually the additional information that is provided in the balance sheet at the most is debtors less than 6 months and greater than 6 months. Beyond this, it is very difficult to find out what is the any additional information which you might require. But in your process of analyzing the particular company, you might want to know who are the top 5 debtors, right? Who are the top 5 debtors, or is there any one particular company that is contributing more than 80% of the total sales? There are many things you want to dig into because you are doubtful about this company. So this information is not provided in the balance sheet, right? Maybe companies, large companies, listed companies, which do prepare financial statements in a very professional manner, maybe they in the notes to account provide some additional information like breakout of large debtors and stuff like that. But for a small company, small firms like a partnership firm or proprietorship firm, you may not find this information readily in the balance sheet. So you need to be aware that this information, every information which you want, the additional information which you want, is available in the backup registers, and that is what we'll be discussing in this chapter. They are books of accounts that we maintain in the course of accounting, called journals, ledgers, and these books, what they do is they provide the additional information which we want. Any information which you want as a banker is available in the backup registers. See, these are backup registers. These are not the books of account that is presented to the banker. The only financial statement that is present to you is the P&L account or the balance sheet, right, and the cash flow statement. But there are additional books in which there is a lot of information which, if you require, should the case arise you require, they will be available. So you should be aware that there is a scope for obtaining the information. So you should have the idea that this information is available at that place. So in case you require, in case of a really bad company, you need to really dig deep into the financials, you want to know additional information. So if you know information is available where, then you can call upon the company to furnish the additional information. So to fulfill these two purposes, we are discussing this particular chapter. Once again, this is a optional chapter. If you're not comfortable with it, you can skip it. So what I would suggest is just listen to this chapter as a story. Just listen to it as a story, nothing more than story. I want you to really break your head trying to understand, right? Only as a story. Just listen. If you can understand 10% of the chapter, that's fine. 20% fine. 100% fine. But if you don't understand even a bit, of this chapter, it doesn't matter, right? Just listen to it as a story, because this is a very technical chapter. Commerce graduates like BCom, MCom, ICWA, and chartered accountants. These are the people who actually get into this particular area, the preparation of the actual balance sheet. So since you're not concerned with this chapter, what I suggest is just listen to what's going on, right? It doesn't matter how much you grasp in this chapter, but just listen to it as a story. Okay, so there are 3 steps involved in the accounting process, right? There are 3 steps: recording, classification, and preparation of the financials. Out of these 3, we'll be discussing recording and classification in this chapter. We'll not be going to the 3rd step, preparation of financial statement, because this is really advanced, right? This is a very advanced topic. In fact, it is beyond the scope of this book to discuss even this. Even at a rudimentary level, we can't be discussing this, because this has issues like adjustment entries. You need to pass adjustment entries to prepare the balance sheet. So it becomes very technical. So we will not be discussing this particular step. So what we'll be discussing in this chapter is the first 2 stages in the accounting process, that is recording and classification. This stage I'll also like to clarify a difference between the 2 terms which are normally used interchangeably: accounting and bookkeeping. They are used synonymously, but there is a slight difference. Please note that. We have discussed that there are 3 stages in the accounting process: recording, classification, and preparation of financial statements. Of these 3, the first stage, right, the process of only recording the transactions, is referred to as bookkeeping, right? Whereas accounting also involves classification and preparation of financial statements. So accounting is a broader concept which includes bookkeeping, and in addition to bookkeeping, we also have the classification and the preparation stages, right? So we'll start with the first stage of the accounting process, and that is journal, right? So journal is the first stage of accounting process. So what this stage pertains is it pertains to the recording of transactions. See, normally a company will be having hundreds and thousands of transactions that occur in the normal course of business. Even in one single day, you can have thousands of transactions. What is a transaction? A single sale is a transaction. A purchase is a transaction. You pay salaries to your employees, it is a transaction. Right? You pay tax, it's a transaction. See, each and every event that involves a financial aspect is a transaction. Just take the simple example of your neighborhood kirana shop. Okay, even he will be having some hundreds of transactions per day. See, when he sells a soap, it is a one transaction, right? When he sells a small chocolate, it is a second transaction. So each sale is a transaction. In addition, he'll be purchasing it from other suppliers. So each and every purchase is a transaction, right? Maybe that at the end of the day, he'll deposit this cash in his bank account. Even that is a transaction. So each and every event that has a financial aspect to it is a transaction. So you can imagine the quantum of transactions that go into a very large company. Transactions might run into thousands, 10,000s, or lakhs. We don't know, right? So what this book called journal does is, in this journal we'll be entering all the transactions. Each and every transaction that occurs goes into the journal, and hence this journal is known as the book of original entry, right? This is the first point where transactions get entered, and therefore this book is called the book of original entry. And in this stage there will be no grouping or classification. Okay, we neither group nor classify, we just enter in a chronological order, right? What is a chronological order? Let us say we are starting this business at 10 a.m. today, right? So this is the first day of a business. At 10 a.m. we have started a business, and the first transaction we are doing is we bought a let's say a raw material, whatever it is, for this particular business, right? That enters in the book of accounts. Then at 10:05 maybe we needed to give a cash advance to our accountant for petty cash, right? For meeting petty expenses like distributing sweets, because it's the first day. So petty cash given to the accountant for purchase of miscellaneous stuff. Even that is a transaction that gets entered in the journal. Maybe at 10:10 you sold your first product, that gets into the journal. So in a chronological order, right? In a chronological order, day by day, all the transactions get entered in the books of accounts, right? There is no priority here. There's nothing like a major amount getting in first, like smaller amounts being relegated. There's nothing like that, right? Every transaction gets entered in the chronological order, and you have to understand there is a particular format in which transactions are entered. Transactions are entered in the journal in a particular format, right? In this format. So for example, if the proprietor infuses capital into the business, right? So we earlier discussed in the chapter 2, like The two heads that will be account that will be affected to this particular transaction, the cash account and the capital account, right? So we also discussed briefly about debit and credit. Anyway, we're going to elaborate in this particular chapter, but the cash account gets debited and the capital account gets credited, right? We will discuss it why this happens. So this is the way in which we enter this particular transaction. We say cash account debtor, we write the amount to capital account and we write the amount. This is the particular form. There is a particular format in which we write the journal entries, and it is practiced universally, and you need to know this format if you are into accounting. For your purpose you do not require, but please understand that there is a particular format in which journal entries are passed into the book, right? Actually this particular column, right, this particular column comes from a particular table, right? And out of this table, one particular column we are showing it here, that is the particulars column. See, under this table there is a particulars column, and from that particular column we are showing one part of it. Actually this is how the total journal looks like, right? This journal actually looks like this. So there will be a journal voucher number, right? There will be a journal voucher number, the date of the transaction, and the particulars which we discussed earlier, right? So here we write the cash account debtor to capital account, taking the previous example. And then we have ledger folio, we have the credit amount and the debit amount. This is actually how a journal looks like. So each and every transactions, right? Each and every transaction gets entered in a chronological order into this particular register, right? So we discussed in chapter 2 regarding the rules for debit and credit, and we said we debit all expenses and assets, right? Whereas we credit all income and liabilities. And we discussed this particular table, right? We showed we will debit all expenses and assets, and we credit all incomes and liabilities. So actually when we say take the first item, when we are saying credit income, what we are saying is when there is an increase in income, right? When there is increase in income, you credit. That's what we are saying. So what happens if the decrease? It will be the negative effect. So it will be a debit. So this second column elaborates on the first column, the first table, right? So increase the first four are actually same, right? So increase in income, credit, right? Increase in expense will be debit. The increase in liability. So all these four are increases. So they gets replicated here. So what happens if there is a decrease? In decrease in income, we have a negative effect. So this is a negative effect. While an increase in income will form a credit effect, decrease in income form a debit effect. So again, these two are opposite transactions. So the totally 8 transactions. And once you are aware of this particular table, you can fit into any transaction into the journal. That doesn't mean I want you to remember this, right? I'm just telling you this particular table forms the basis of all our entries into the journal. So continuing with our previous example where the owner has infused 1 lakh capital into the business. So let us see how it is passed into the journal, right? First of all, we have to see what this transaction means. So in this transaction, the owner is infusing cash into the business. So the heads that are affected here is the cash. So head 1 will be the head 2 is the cash and head 2 is the capital. So cash and capital are the two heads that are affected. This we have discussed earlier. So what we do here is we have to identify under which of these 4 we already discussed earlier, right? The 4 major heads we need to remember are the income, expense, or the liability, or asset. So every head we need to fit into one of these 4. So what is capital? Capital is actual liability. This we have discussed again once in chapter 2, right? Liabilities are sources of funds. So from where did we get funds? And we spoke of a concept called business entity concept, where we treat the owner separate from the business. So owner is just an outside party from which the company has borrowed funds. So capital is a liability because we have borrowed from the owner and we need to repay it to him. So capital becomes a liability. The other head, cash will be a, let's see here, cash, is it an income, expense, liability, or asset? We said cash is an asset. In fact, we said cash is the supreme form of asset. Asset is anything that can be converted into cash. So land is an asset, building is an asset, machinery is an asset. We also spoke of services being asset in the sense that if you paid for the service but you are yet to receive it, that is also an asset. And any asset that anything that can be converted into cash is an asset. So cash itself is an asset. It's a supreme form of asset. So the thing you have to do is, once you identify which are the 2 heads that are affected by a transaction, we then classify it into the 2 particular heads. So capital is a liability and cash is an asset. and then we refer to the previous table, right? Remember that eight rows table where we said income, if it is an increase in income, it will have a credit effect. If it's a decrease in income, it will have a debit effect. So totally 8 rows we have discussed. Then we will see what is happening here. This is a liability and it is an increase. So what is the rule? What is the increase in liability? If you refer to the previous table, increase in liability, just see what is the increase in liability. So it is here, right? Increase in liability is here. It is a credit effect. And cash is a asset. So there is an increase in cash, increase in asset. So there is a debit effect, right? So what we do, we then identify what is the debit effect and what is the credit effect. So here, increase in liability is a capital, is a increase in liability is a credit effect, right? Increase in cash is a debit effect. So this is what you should be doing for every transaction. So for every transaction, you should identify which are the two heads that are affected, and then which is the debit effect, which is the credit effect. You should be able to identify. Once again, this is a complicated concept, but then with practice you're going to get it. The point is you're not going to practice it because this is not your area of expertise, right? But then with practice this becomes very easy. In fact, accountants keep doing it on the fly. Like they don't even think of this table, which are the two heads that are affected, what is increase or decrease, is it a liability. They don't think about all this. Simple transaction, they straight away enter the books of account. Take for example, company purchased land, right? The company purchased land by taking a loan from the bank, right? This is a simple transaction. What the accountant doesn't even, what the accountant does is he doesn't even think of this table, right? He straight away sees the transaction and says, okay, he straight away writes land account data to bank loan account straight away. I mean, it happens subconsciously. You don't even need to think about what is an asset, what is a liability, whether it's increase, decrease, because by practice you get to this stage. You get by practicing hundreds and thousands of entries, you get to a stage where this becomes automatic. I mean, you don't even think what is the debit effect, nor is the credit effect. This happens automatically. The point is you are not going to do this, so maybe it will be difficult for you to do this. But then please understand that this is not that difficult once you have a practice. So this table might look very complicated to you, because for each and every transaction, if you are going to do this table, and we spoke of hundreds and thousands of transactions for every one particular, it must be a very tedious job to pass journal entries, but that doesn't happen, right? Passing journal entries is relatively easy. For anyone with practice, it becomes a routine job, right? It is a very routine job. Things like journal entries are passed, even complicated entries are passed regularly by practicing accountants. So what we'll do now is take a few examples just to comfortable with this concept of debit effect and credit effect, right? So let us take this transaction where loan is taken from bank. So please note that when you take the loan from bank, what happens is you're getting cash, right? Cash is coming into the business. The bank is giving you cash, right? So now there is also a liability in the sense that you have to pay back this loan to the bank in future. So that is a liability, right? This is not an asset, right? You have to make a distinction between what is a liability and what is an asset. A liability is a source of fund. You have borrowed, right, funds from this particular source. So there is a liability to repay. Any source from which you borrow from, you have to repay, right? So there is an obligation to repay. So this is a liability. Any source of fund is a liability. Whereas asset, we have discussed earlier, what we have done with this source of funds, to what use we have put this funds. So you could have purchased land, you could have purchased machinery, so whatever it is, anything that can be converted into cash is an asset. So here loan is a liability, right? Because we have borrowed funds from the bank and we are liable to repay it, right? So that is a liability. Cash in a way is a asset. It's a supreme form of asset. So the two heads that are affected in this particular transaction are the cash account and the bank account. Bank account is a liability. An increase in liability, what do we do? Increase in liability, we said credit all income and liability. So this is a credit effect. And what happens to the cash? Cash is a asset. So we debit all expenses. So increase in asset is a debit effect, right? So what is the debit effect here and what is the credit effect here? So for every transaction you have to identify which are the two heads in this account is the cash account and the bank account, right? And the debit effect will be the asset. So here is the cash and here is the bank account, right? Bank loan account is the credit effect. So for every transaction you have to identify which are the two heads that are affected and which is the debit effect and which is the credit effect. Let us take another transaction. In this transaction we are purchasing raw material for cash. So what is happening to cash? Cash is going out of the business, so it is decreasing. Okay, cash is decreasing. So earlier we spoke of the rule that we debit all expenses and assets, right? So this applies for the increase, right? So whenever there is an increase in the expense or increase in asset, we debit that account. But here cash is decreasing, cash is an asset and is decreasing, so we do the opposite, right? So when there is a decrease in asset, what we do, credit. It's an opposite effect. So here we have to credit the cash. So see here, we are crediting. Decrease in asset is a credit effect. What is the other head that is affected? Since you're purchasing raw material, inventory is the other head. But please recall our earlier discussion, chapter 2, where we said only assets that are going to be remaining in the business, like land and building, machinery, those are going to be account asset heads. Raw material we're not going to treat it as an head. Like what we do is we affect the purchases head. So let us take the purchases head, right? And since purchase is an expense, so we debit all expense. So debit all expenses, so it will be a debit effect. Okay. Just listen to this chapter as a story. As I told you, you need not actually get into the what are the two heads, what is affected, what is increase, what is decrease, what is credit effect, what is debit effect. Try to grasp as much as you can. Even if you doesn't grasp, even if you're not able to grasp even an iota of this chapter, it doesn't matter. Okay, just for the sake of completeness, we're discussing this chapter. So we'll go on and see a couple of more examples. So in the third transaction here, we're purchasing raw material from X on credit. So in the earlier transaction 2, we have purchased on cash, right? So purchased on cash. In this transaction, we're purchasing on credit. So anyway, the purchase head will not change. It is same as in the second example. So purchase is an expense, and since we debit all expense, so the purchase will have a debit effect. So purchase is an expense, it's a debit effect, right? That is clear. So what happens to the other entry? The other head that is affected here is the X, right? And see, we procure the material, we had started using the material, but we didn't pay for him because it's on credit. So we'll pay him later, maybe after 30 days or 45 days. So there's a liability here, right? We have to pay to this particular supplier in future. So there is a liability. We received the material, but we didn't pay. So there is a liability. So what we do? We credit all a credit effect, right? So this is a credit effect. So two heads. One is the debit effect and the other is a credit effect. The debit effect is the purchases, right? And the credit effect is the X account, right? Let us take fourth example. Here goods are sold for cash, right? So when you sell goods for cash, cash is coming into the business. So your cash is increasing. So cash is an asset. So what we do? We'll debit all assets, right? So cash is a debit effect since we debit all assets, right? So what is the other head that is affected? So goods are sold. So it is a sales account. Okay. Please remember we are not touching the inventory account as discussed in the chapter 2. So sales account. So what is sale? Sale is an income. So what we do? We credit all income and liabilities. This we discussed, right? So we credit all incomes. So since this is an income, we have a credit effect. So two effects. One is the debit effect and the credit effect. The debit effect is the cash effect and the sales account is the credit effect. Next example, goods sold on credit to Y. In the earlier example, we sold goods for cash. In this example, we are selling on credit. So the sales account will not change, right? Sales is an income. So since we credit all incomes, the credit effect is same. So let us see the debit effect here. We sold the goods to Y, but we are not yet received the sale amount. But we are going to receive this amount from the customer in future. So after 30 days or 45 days or 60 days, we are going to receive the amount from the customer. So this customer is actually an asset to us. Please see the difference in the earlier example where we spoke of a customer called Y, a raw material supplier called Y, from whom we have purchased material and we didn't pay. In that case, he is a liability because we have to pay to this supplier. We have taken goods from him, but we didn't pay as on date. So that is a liability. This is the different case. Here we have sold the goods to Y and we are to get the amount, right? In the case of X, we have to pay him. So that is a liability. But in case of Y, Y has to pay us, right? So that is a asset. So please remember, asset is anything that can be converted into cash. This receivable, this item called debtor or receivable, will be converted into cash in future, right? We are going to realize cash from this customer. So this is an asset. So what we do, we debit all assets. So this is a debit effect. right? So two effects, debit effect and the credit effect. So in this case the credit effect is the sales, debit effect is the vice account. Okay, so in this example we are purchasing machinery for cash. So cash is going out, that means the decrease. So usually we debit all assets. Cash is an asset, we debit all assets. But then this is for increase. Since it is a decrease, what we do, we credit. So this is a credit effect, right? Cash is a credit effect. Okay. So what is the other head that is affected here? So machinery is coming in, right? So machinery is an asset, we told you already, right? Machinery is also an asset, but then machinery is increasing here. Okay, so in this example two heads, both assets are affected, but one is an increase and another is a decrease. So cash is decreasing, machinery is increasing. So we debit all increase in assets, right? So this is a debit effect. So machinery is a two effects, right? Machinery is a increase, so this is a debit effect, and we have a cash effect, that is the credit, right? So it's a good example where both the same heads are affected in this example, that is the asset head. Earlier we have seen examples where liability is one head and the asset is other head. In this example both are assets, but one is increasing and other is decreasing, right? Let us take this example. Here the owner has withdrawn cash for his personal use, not related to business. So from the point of view of the business, the owner is an outside party from whom we have borrowed, right? We have borrowed funds called capital. This is a special name to the funds lent by the promoter of the company called the capital. So now since he is drawing, say for example he has invested 1000, right? So now he has come and withdrawn 100 for his personal use. So now we are liable to pay only 900. So capital is a liability, right? But now we are liable to pay only 900. The business has to pay a lesser amount because the owner withdrew this 100 for his personal use. So now the business is only liable to pay 900 as against the earlier 1000. So please remember, the liability, the owner's capital is a liability, right? Liability is a source of fund and capital is also a source of fund. So here it is decreasing. So usually we credit all income and liabilities. So here it is the opposite effect. So we debit, right? So we debit. Decrease in liability is a debit effect. So what is the other effect that is affected? Cash, right? Cash is going out in the business. Usually we debit all assets. Cash is an asset, we debit all assets. That is for the increase. Since cash is decreasing, we credit. So decrease in asset is a credit effect. Okay. So let us take one more example, last example. Here we have bought chairs on credit from P. Okay, this is a credit transaction, and we bought some chairs. We don't we don't usually maintain a separate head called chairs. You have something called a furniture account. Usually you can have a separate account chairs if you require. So furniture is an asset. So since we have bought chairs, asset is increasing, so we debit all assets. So increase in asset is a debit effect. There is one effect. What is the other thing, right? Since we are purchasing this on credit, right? So now we are liable. We are creating a liability. We are liable to pay to P. Since we bought this chairs on credit, so we credit all incomes and liability. So we increase in liability is a credit effect. So we credit P's account. Okay. So as I already told you, even though we have taken a lot of time in identifying which are the two heads that are affected and what is the debit effect and what is the credit effect, accountants do it really fast, right? They don't even think about it for a moment. It's done with practice, right? It's done automatically. So with practice you will attain the same level of speed, but which you need not be doing. Okay, so don't be terrified that this is a very lengthy procedure. It's done very automatically. So once you enter, right? So once you identified, as in the previous 8 examples which are discussed, right? Which are the two heads that are affected and what is the credit effect and what is the debit effect. So what we then do is we post the journal entries. Please recall this is the format which we discussed earlier. So we have a journal version number, we have a date, particulars, ledger folio, credit and debit. It's the format of the journal. So what we do is take the first example. The first example is where we have borrowed loan from a bank. So we have passed this entry, right? Cash account debit to bank account, because cash is coming into the business. Cash is an asset. Since we debit all assets, this is the debit effect. And since we are taking a loan, okay, loan is a liability. And since we credit all income and liabilities, this is a credit effect. So see here. So what we're doing now is, and the cash account since the debit, right, and the bank account is a credit effect. Okay. So this is how we pass the entries. So cash account debit to bank account. See, cash account is a debit effect, right? So we write cash account debit, right? Bank account is a credit effect. So to bank account. This is the particular format in which you write. So don't question this format. This is how it is written. So the debit effect gets written in the first line, and then a word comes to the particular credit effect, okay? And the particular amounts gets entered in the credit and debit columns, and these amounts anyway will be same, right? That is as per the dual aspect. So as the business runs, right, day by day, you go on posting this journal entries in this particular journal, in this particular format. Each and every transaction you identify two heads, you identify which is the debit effect and which is the credit effect, and you pass on entries in this particular format. So June 14th, this particular transaction, we have purchased some material on credit from X, so this gets passed. Then 16th we have 3 transactions, then 25th, and so as the days pass, each and every day whatever the transactions, you keep dumping into the journal in a chronological order. So this is how a finished journal might look for a particular month. For the month of June, this is how a journal might look for this particular. I would now like to mention briefly about a small modification to the earlier process which we discussed. I told you that journal is a chronological entry of all transactions, right? But what actually happens is something called journal proper, okay? Journal proper, and there's something called subsidiary books. So you might have realized right now that journal becomes a very bulky sort of register. I mean, if you keep on entering each and every transaction, it becomes a very bulky register, isn't it? And for a company, the major transactions pertain to sales and purchases, right? And cash. These are the major transactions. So sales is something the company does on a daily basis, right? Whether cash sales or credit sales. And purchases is something that it does on a daily basis. Cash is anyway, I mean, the most important register. It keeps happening every day. So there are certain books which the company maintains called the subsidiary books. So usually the company maintains these particular books, right? It maintains a sales day book, purchases day book, sales return, purchases return, cash book, bills receivable, and bills payable. These are the books which the company usually use, and these books are known as the subsidiary books, okay? These books are known as the subsidiary books. So any transactions pertaining to sales or purchase or cash on these particular items gets entered in the particular book. So here we have discussed how many books: 1, 2, 3, 4, 5, 6, 7. So any 7 books we are maintaining. So any transaction that pertains to these particular heads will be entered into this subsidiary book. So for example, we have made a sale. Let it be a cash sale or a credit sale, doesn't matter. So we dump it into the sales day book, okay? If it's a purchase, we put in the purchase day book. So any transaction that doesn't fit into these 7 books, only those will be entering into a journal proper, okay? So we earlier told that every transaction gets entered in the journal. So now I'm making a small model. Not every transaction gets entered in the journal. We maintain something called a journal proper, and we maintain something called subsidiary books. Any transaction that doesn't get into the subsidiary books, only that particular transaction will be going into the journal proper. For the majority of the transactions, the major transactions like sales and purchases gets into the subsidiary books called sales day book and the purchase day book. And only those transactions that we are unable to enter into the subsidiary books will be coming to the journal proper, okay? Once again, this is not required for our purpose, but since we come to the concept of subsidiary books, I would like to tell you how it actually is done. Again, we need not get into this at all. Just for the conceptual clarity, we are discussing this, okay? So we're not going to discuss all subsidiary books. Let us take a sales day book. So this is how a sales day book might look like, okay? So what we do is in a chronological order, we enter the sales. So here we have a new column called customer, because this is a subsidiary book related only to sales. So we need to keep a track of the customer. So we write the customers here, and we mention the sale amount. So the total of this particular sales day book for a particular month will be giving the total sales of that particular month. So in this October, the company has made a sales of 1330, okay? So what we then do is, we make a combined entry. Instead of passing individual entries to the journal, right, we maintain a separate subsidiary book called the sales day book. Actually, as per our original concept, all entries should be entered in the journal. So actually these individual transactions, individual sales should have been entered in the journal. But what we did, we maintained a subsidiary book called the sales day book, and then we entered all these amount. So now what we do, we take the total amount, and this particular, only this particular total transaction will be passing into the journal proper, right? We pass a single entry called debtors debit to sales account, a single entry. Similarly, in the purchases debit, we pass a single entry to the journal proper, right? Purchase account data to creditors. So whatever is total amount, we pass a single journal entry. Okay. So we now come to the second stage of the accounting process. So in the first stage, we have discussed about the recording of transactions. So recording of transactions is done in a book called journal. Journal is a book of original entry. And we also seen that instead of maintaining one single journal, which will be bulky because sales and purchases will be having a lot of entries, we maintain separate books called subsidiary books. And based on the type of business we have, we can maintain as many books as we want. Usually we maintain sales day book and the purchases day book and the cash book. Based on your requirement, we can maintain additional books. And then the total of that particular books will be passing a single entry into the journal proper. So that is what we did in the first stage. So in the second stage, what we do is the classification. Please note that journal is and by itself it's of no use to us. So what does journal tell us? Journal is basically unprocessed data, right? It is only a chronological entry, right? It is unprocessed. Take this example where we are maintaining daily temperature, right, for every 5 minutes. So now the temperature is 32 degrees centigrade. After 5 minutes, I'm going to take a fresh reading. It is 32. In the next 5 minutes, I'm going to take 31. Maybe then it drops in the night to go on like this. And night maybe it drops 29. So for every 5 minutes, I'm taking a temperature. Let us assume. So in 1 hour, we'll have 12 readings. We'll have 288 in a day. In a year, we'll be having more than 1 lakh readings. So now I make a list. This 1 lakh readings, I make a list like this: 32, 32.2, 32.1, 33.6. I go on making 1 lakh entries. I print a book, a bulky round book, and I throw it in your face, right? I make a book of this 1 lakh listing and throw it on your face. So what are you going to do with this 1 lakh readings? A book of thousands of pages with nothing but these numbers. Can you make any sense of it, right? You can't make any sense of it because this is unprocessed data. So what we need is useful information. We don't need all those 1,000 pages. All we need is a one single page. If you're going to give me one single page, like saying what is the maximum temperature, what is the minimum temperature, what is the range, right? So for how many days in a year, right? Since we are speaking of for 1 year, so out of 365 days, how many days was the temperature more than 30 degrees? So in how many days was temperature less than 25 degrees? So if you can answer me some specific questions, that will be of more use to me rather than giving me unprocessed data of 1 lakh readings, right? So what you basically need is not unprocessed raw data. You need information. So what the journal is doing, it is providing you raw data, but you need to convert this data into useful information, and that means you have to classify this. You have to classify this particular journal entries, and that is the process of classification. The second stage of accounting is the classification. In this stage, what we do is we have something called ledgers, right? So we segregate the journal entries under various heads in a book called ledger, right? So we maintain a ledger for each head. This will help us in better information, better control over a business, as we are going to see. So please recall our earlier example where we have prepared this particular journal transactions. We have taken 8 examples and we have passed the debit entries and the credit entries. So this is the example which I taken in an earlier slide. Okay. So let us take the first entry. Right. In the first entry, what we said, we had cash account is debited and bank account is credited. Okay. So we have a transaction in which 2 heads are affected. One is the cash head and another is the bank head. One is the debit effect, there is a cash is the debit effect, and bank is the credit effect. So what we do is we open 2 pages in the ledger. Okay, so one for the cash account and one for the bank account in this particular format. Okay, the ledger will be having 2 heads. One is the debit and the other is the credit, and in each head will be mentioning what is the date, what is the particulars, journal folio, and amount. This is how we draw up a ledger. For each head, we will be having a separate page. Okay, this book is known as the ledger, and then we record the transactions. So we have cash account debit and bank account is the credit effect. So what we do, under the debit, the cash amount, we'll be writing the amount, right? So let us assume this is the cash side. Please note that we are going to open a head for each and every head which we discussed earlier. So for cash there will be separate page on the ledger, for bank account there will be separate page. So let us assume we're in the cash page. So in the cash page, since it's a debit effect, so under the debit side we'll be entering the particular amount. Okay, so we won't touch the credit, because in this particular transaction we don't have any credit effect, in the sense that for cash we are not going to have any credit effect. There is a credit effect for bank account. So when we go to the bank page in the ledger, we'll have a separate page. We'll open a separate page for the bank account. There we'll have a credit entry on this side. Okay, we're going to see that. So this is how the cash account in the ledger will. Let us take this a page one of the ledger. So in one page we'll open the cash account, and this is how it looks like. There will be a debit and then a credit. We won't be having any credit entries here in this particular transaction. So the debit effect is a bank account. So to bank account, and we enter the particular amount. So this journal entry gets transformed into, right? It gets transformed into this particular ledger entry. Okay. Then on another page, right? Let us say this is the page 2 of the ledger. In another page, we'll be opening a separate head called the bank account. So please recall, we're having a cash account and the bank account. So cash is the debit entry and the bank is the credit. So here in the credit side only we'll be entering the, since this is bank account page. Okay, so since the bank is the credit amount, the same amount will be entering in the credit side. Let us take another example. Here we have a second entry, purchase account debit to cash account. That is, we are purchasing material on cash. So purchase account is the debit effect and the cash is the debit effect. So what we do, we open two separate pages in the ledger. So we already opened in page 1 cash, page 2 we already in the ledger we already opened a bank account, bank loan account. Okay, now we'll open a fresh page for purchases. Okay, so what we are going to do is, since we already have a cash page and this new transaction, this purchase account debit to cash account, we're not going to open a fresh page, page 4 for cash. Since it is already open, we continue this entry in the page 1. Alright, so this is how the ledger will be appearing after transaction 2. Please see this cash account. Transaction number 1, where we had a cash account debit to bank account. The first transaction we entered on this side, right? Because cash account is a debit transaction. On this particular side we have entered. In this transaction number 2, where we purchased material for cash, okay, there we have a credit effect to purchase account is debit and cash account is credit. Okay, so in this example we have the cash account that is credit. So in this head we'll be crediting, on the credit side we'll be entering that particular the second transaction. Okay, this amount is obviously different. These are two separate transactions. Since purchases we don't have a head earlier, we create a new page in the ledger on page 3. Okay, and then we, since purchase is a debit effect, on debit side we'll be entering the particular amount. Let us take one more example. Here we have a purchases on credit. Earlier we purchased material on cash, now we're purchasing on credit. So what is the difference? Instead of cash account, we're going to create the X account. Okay, so X will be credit effect and purchases will be the debit effect. Let us see the ledger entry. So the X account, since X is a credit effect, on the credit side, right, we'll be entering the amount. Purchases, in earlier transaction we have 50,000 already. Now in this transaction, this 75,000 will be going in the debit side, right? Since purchase is the debit effect in this particular example. So that is what we actually be doing in the ledger. So for every journal entry, right, we post them into the ledger under two different heads. In one head we enter the debit effect, and another head will be having the credit effect. So in the end what we'll be having is a number of pages, each having a single head, like a sales head or purchases, furniture, each will be a single head. And at the end of the month, this is what our purchase account, for example, right, might look like. So let us assume we are done with 1 month, and let us say the page, what is this, page 3? Page 3 of a ledger where we have purchase account. Maybe it will be looking like this. So in a chronological order, we'll be listing all the transactions, right? So this is Y account, cash account, right? So this is how it might look like at the end of the particular month. Okay, what we do is, once we complete that stage, the next step is we determine the closing balance for the each account head. Since there will be number of entries in one particular, say for example cash, right, there will be number of entries. So what we do is we get the total, and then we take the total, right? Whether it's a debit or a credit, we'll see what is the total, which side is higher. If we have entries on both sides, we net it off. If this side is more, we'll have a debit effect. If this side is more, we have a credit effect. And then we arrive what is the balance. It's a debit balance or a credit balance. So every head in the ledger finally will be having a balance. It will be debit balance or a credit balance. So see this example. The purchases we have no credit entries. We have all the debit entries, obviously, right? So 2,65,000, and this is how we actually do the passing. We write by balance carried down to 2,65,000. Okay, and in the next month balance brought down. This is again a very technical nature of how entries are actually made, which you need not be concerned at all. But this is actually how a purchase account will look at the end of the month. Okay, this stuff like balance carried down and balance brought down, you need not be worried. Okay, similarly the cash account might look something like this. Okay, so you will have some debit effects, we'll have some credit transactions. At the end, what we do is we'll be tallying. So once we are done with that stage of ledger, we next go to the current stage called the trial balance. So what we do is, so at this stage what we've done is, for each and every accounting head which we encounter in our transactions, we'll be preparing a separate page in the ledger. So we have a cash account, we have a purchases account, sales account, machinery account. So many heads we have, but for each head we have summarized the total. So it can be a debit balance or credit balance, but we have the amount. So we have the amount, and we have also it's a debit or a credit balance. So we take this and prepare a table called a trial balance. In this we'll be having a debit and credit column. So all debit. So for example, let us say cash is having a debit balance. So this debit balance, say for example 1 lakh, it comes and sits here for each head. So we see what is the debit and credit, and we enter in the particular. So final trial balance might look something like this, right? This is the trial balance. So for this particular example, cash account, we have a debit balance. Either you're having a debit balance or credit balance. Please see that we can't be having both. Okay, the ledger can have entries on both sides. It can have both the debit entries and the credit entries. But what we're doing at the end of the ledger is we net out the figures. We take the total. Either you'll be having a debit balance or the credit balance. So if it is debit balance, we enter here. If it is credit balance, like in the case of sales, we'll be entering here. At the end, trial balance should tally. And please don't be surprised. This is as per the dual aspect. Right? This is as per the dual aspect. So if you have done everything correctly, the trial balance will tally. I'm not saying it's a foolproof check. This is not a foolproof check, right? What I'm saying is, if you have done everything correctly, the trial balance should tally, right? But just because trial balance has tallied, that doesn't mean that everything is right. You can still be having problems in spite of trial balance tallying. So trial balance is not a foolproof way of check, but it is a preliminary check. The first thing you need to be doing is check the trial balance. If you have done everything correctly, the trial balance should be tallying. So trial balance is tallying because of the dual aspect concept. So if trial balance does not tally, we need to go back. We need to correctly identify what is the mistake, and we need to rectify it. But the opposite, as I said, is not true. If the trial balance tallies, that doesn't mean there is no mistake, right? So it is only a preliminary check. Okay, it's not a foolproof check. So what we do in the next stage is we do some adjustments. This is the actual stage of preparation of financial statements. Please recall that we mentioned there are 3 stages to the accounting. We have a recording stage, we have a classification stage, and we have a preparation stage. I have already mentioned this earlier that we are not going to discuss the preparation stage, because in this stage you are going to pass some adjustment entries and some very advanced stuff which you are not going to go into. So we discussed in detail what is the recording and classification stage. That is sufficient for our purpose. So with this we have come to the end of this chapter. I know there was a lot to understand and digest in this chapter, but as I already mentioned in the beginning, this is an optional chapter. So it doesn't matter even if I have not understood much from this chapter. Maybe you would have grasped only 10 or 20%, but even then that is okay, alright? In this process you have learned some new terms such as journal, trial balance, and ledger. So this will be of use to you should the case arise, okay? And these are not easy stuff. I admit that these are not easy stuff. If you actually talk to someone who prepares this account, it will be a great relief when actually the trial balance tallies. I mean, if you are actually into this particular role, it's such a big headache. I mean, the moment trial balance doesn't tally, you need to keep go on checking. You need to check each and every ledger where it has gone wrong. It's a very a mammoth exercise, and there's a huge relief and trade balance tally. So this is not an easy stuff, okay? But then you're not going to do this, so that's the good part. Through this chapter, compared to someone who has skipped this chapter, because I said this is an optional chapter, if someone has skipped this chapter, they can still go on and follow the rest of the book. But compared to them, you'll be in a better position to understand the nuances and the analysis of financial statements. Okay, so don't lose heart if this chapter was really advanced for you. This chapter is actually advanced. The accounting process is something done by professionals, professional accountants. So this is an advanced topic which you're not expected to be proficient at. Okay, so don't worry if it went over your head. Okay, so irrespective of whatever you learn from this chapter, we can now move on to the next chapter. In chapter 4, we'll be discussing the brief introduction of the major financial statements that you'll be encountering in your day-to-day life, like P&L account, balance sheet, and cash flow statement. Okay, see you then.